from The Simple Investor, where each video I try to bring you the latest cold hard facts and information about the stocks and the UK economy to give you the tools and understanding to go forward with your own investing and value investing to make some money, hopefully. That's the aim of the game, isn't it? So this week I want to be talking about interest rates and the part that they play in not just the economy as a whole, but the interactions that they have with stocks. And a lot of people I've seen online don't quite tie the two together. I'm sure if you sat them down and asked them, they would give you an answer that was there or thereabouts. But I think it's important for a value investor in particular, and anyone who's looking at UK stocks, to take into account what's going on in the macro environment and the political sphere and the banking sphere, and really understand how that plays into the stocks you're buying and the influence that will have on the price. Because as everyone who puts money into the stock exchange in exchange for shares will know, is you can do the best amount of research possible on a company and know it from top to bottom and inside out, and the share price can still go down on you. And there is a number of factors behind that, and you could spend hours talking about it, but this video is intended to just quickly talk to you about why interest rates are so important to your portfolio. So if we get into it, I think it's worth going back to basics. And don't worry, this isn't going to be like an economics seminar, because I myself would fall asleep, much like I did in the Grand Prix yesterday. But that's a different story. So what we have here is a very basic supply and demand chart. This is going back to basics on why ultimately stocks, well, anything really in the economy, but they're talking about stocks, but go up and down, and the sort of premise that underpins it. I mean, this rule applies to absolutely everything, from the price of washing up liquid to the price of your cat food or whatever. But keeping it in line with stocks, as you'll all be aware, is all stocks are trading on exchanges, which is essentially a market that you can go and purchase a product, a stock, at the price that someone is willing to sell it at. And that price that someone is willing to sell it at is largely dependent on this chart. Put very simply, if there is more demand for a product, the supply inevitably dwindles, thereby raising the price of that product. And that's not a complicated thing, and people sometimes forget the basics and how that applies to what they're actually doing. So run a real life example. If you want to go and buy yourself a new set of Nike shoes, there are other shoes available, Nike Air Force Ones, I recently bought myself a pair actually, but and everybody in your building also wants to go and buy Nike Air Force Ones, the price will inevitably rise because there's going to be fewer pairs of shoes available, right? So the seller can sell them at a higher price and get more for their money. As supply dwindles, the price goes up. So it's not rocket science. It's just very basic economics, and there's a lot of theory behind markets and free markets and perfect markets and things, which we don't need to go into. But that is the basic premise. So, all right, okay, economics lesson over. You're probably sat there saying, well, how does this apply to stocks? And what difference does interest rate, how does interest rate even come into that? So if we just go to interest rates here, you can see the history of the UK interest rates on this chart quite clearly. And you can see here that as of now, the Bank of England's set rate is 5.25%, which is similar to identical to the rate back in 2008. And in between, obviously, we've got the glory years, which we'll all look back on fondly and wish we'd have borrowed a bit more at that time. But What interest rates are effectively are a lever that the Bank of England can apply to manage the flow of money and ultimately the economy. And what the Bank of England do is they manipulate the interest rate to the needs of the economy. So what generally happens is inflation may start to rise because of demand outweighing supply, prices being driven up, and here you can see a spike in 2022 of inflation, which shows the rate at which goods are growing. So each year it's growing at that percentage. It doesn't. If inflation comes down, it doesn't mean the prices stop going up. It's just the rate by which they are going up. So the UK is facing a period of high inflation, which means goods are going up, which means demand is technically too high on a base level, trying to keep it simple as possible. Demand is too high. What can the government do to take consumer demand down? What they do choose to do is use the interest rates as a lever to manage inflation. So by raising the interest rates, it encourages people to borrow less, so they have less spending capital available, or save more, so they have less. So it takes money out of the economy that people go and buy on their general goods or luxury goods or whatever. So you're encouraged to put your money in the bank and not spend it. By doing so, you take demand out of the economy, and you take demand away from markets where demand is in balance with supply, and that's why inflation's at a high. So by doing so, you bring that back into more equilibrium, right? So the price of the goods stop rising so quickly because demand is diminished, which means supply begins to replenish the market, if you like, and prices start to grow, but at a slower rate and more in line with what people can actually afford. So that's the interaction between interest rate and inflation. So what does that mean for stocks? So as we can see here, the Bank of England have got the interest rate set at 5.25%, which is a 16-year high since 2008, before the collapse. Once the collapse happened, the government needed to encourage spending in the economy and stimulate the economy because of the banking crisis in around 2008. By doing so, the interest rates plummeted to record lows of 0.5, 0.75, even 0.1 around 2020, which seems like madness to me now, and why we didn't make the most of it. Well, I certainly feel like I could have utilised those interest rates a bit better, but that's a different story. By doing that, the banks have attempted to stimulate the economy and revive it following the banking crisis. Off the back of that has inevitably led to additional money in the markets. Demand has therefore crept up, supply has therefore diminished, inflation has therefore risen, and now the banks are reacting by raising interest rates to curb that. Okay, brilliant. So let's talk about why that affects your stocks. As of now, there is a lot of money, and I'm not talking about money that you might have in savings, albeit that might be a healthy amount. I'm talking about a lot of money from the uber wealthy wrapped up in the banks, because they'll be sat happy with a very comfortable 5% return on their money as of now. And I'm talking serious money. Just to give it some perspective, over the COVID period, the government increased their borrowing to 313 billion. And I think here it says about £6,100 per person was spent in the UK over the COVID period by the government. Now, if you speak to the average person on the street, they have not got £6,100 in their bank accounts. You may have, but the average working class man and woman don't have that. They're struggling. There's been a real drop in living standards over the past 3 to 5 years. And these people don't have that money, and that money must be somewhere. And where it is in the pockets of the uber wealthy who are currently sitting on the high interest rates run by the UK. Now, as you'll have seen in the news, I'm sure, the Bank of England are slowly coming around to the idea of reducing the interest rate. As you can see here, the consensus in vote at the Bank of England to reduce the rate is still heavily in favour of maintaining it, but a couple of them here, as you can see, 2 of the 9 voted for a rate cut, and it's anticipated that this may be more in June and particularly August when the interest rate decisions are made. What that means is if we can tap into what the banks are thinking based off the inflation levels and then transpired to the bank interest levels, what that means is what you can do and what I can do is start to predict where the flow of money from the uber wealthy is going to go, because they're the ones ultimately that will really affect the markets. You know, they're the ones that cause things to rise and fall. They're the market movers compared to you and I, who, you know, put to all intents and purposes a good amount of money into the stock exchanges, but compared to these guys, you know, I'm myself am a small fry. So understanding where the flow of money is from them is so important. And what we've got here is an opportunity, one, for me to explain it, but 2, for you to now take note, if you're not already doing so, and follow these interest rates off the back of inflation rates, and understand what that's going to do. So if the uber wealthy are sat with their money in the banks, earning a nice pretty 5% on their millions and billions, when that starts to drop, that will be when the decision will be made for them to remove their money from the banks and either sell it for another currency, which is, you know, you'll read warnings about economists saying it will devalue the pound because a lot of people take their money out of UK banks, which can go and find a better interest rate overseas in a stable currency somewhere, which you know, which will saturate the supply of the British pound, which will mean it devalues because supply outweighs demand. Conversely, what a deduction in or a reduction in interest rates will mean is the money coming out of the banks from the uber wealthy will need to go somewhere because they've got too much money to spend each day and each week. They've got their assets, they've got the lifestyle they live. They just need a return on the excess passive income that they make and to generate more and more wealth, right? So they'll take that money out of the banks and they will put it somewhere, and that place that they'll put it, in my mind, will be in assets. Those assets will either be property, and we'll see a significant spike, particularly in 2025, I believe, when the interest rates will be a lot lower, when there'll be a particular spike in the property prices because the uber wealthy are soaking up property with their money that they've taken out of the banks because they'll get a better return. What they'll also do is buy assets in the stock markets and bury their money in that. And again, I think we'll see a real rally in the stock prices once that happens. On top of that, I think included in that, I think things like gold, silver, copper, those sorts of products will also see, commodities will see a real spike when the interest rates comes down. So it's something that we as value investors need to be completely dialed into, and if you're not, you should be marking on your calendar the interest rates and following the Bank of England's split decision, so you can start to get a slight edge on the others who aren't monitoring this, so you can see the flow of money. And the reverse works too. So if inflation starts to stay down, and if the Bank of England's interest rates go so low again, back to 0.1 or whatever it was, inflation may start to creep up, and you might see interest rates going up again in the future at some point. And what that would mean is money sucked out of the assets that I just mentioned and put back into bank accounts, because that's where a real consistent solid rate of return is. So timing your entry and exits in the market is absolutely key, or at least understanding why your stock is moving with the backdrop of interest rates is absolutely key, guys. And if you are not monitoring it and you're not on top of it, you can be sat there thinking, why is the stock I just purchased with all this great research and it's got the best balance sheet in the world going down? And it might have nothing to do with it being the wrong pick. It's just your timing and the geopolitical backdrop isn't right. So you just need to make sure that you are clued in. I hope that has made complete sense. If you have valued what I said, give this video a like or subscribe. I could do with at least one subscriber. But these are all the things that I would be doing anyway. So it's great to just put this out into the ether, and if it adds value to someone else or teaches someone else something, then I'm happy that I've steered them away from the technical FUD and bag shilling YouTube finance videos that kind of have saturated this sector. Well, anyway, guys, like I said, I hope that's been really helpful. Enjoy your bank holiday weekends. All the best. Keep it simple.